As I said, the President announced certain measures in respect of COVID-19. This slide actually gives you the ones that he didn't announce. So for income tax, he talked about a reduction of the corporate tax rate for resident companies, and I stress only resident companies, to 25%. So a non-resident company will still be taxed at 37.5%. He talked about the increase of the personal relief for individuals earning below Kenya shillings 24,000, and therefore they are now tax-free. He removed the top rate of personal tax of 30% and has proposed it at 25%, and he reduced the turnover, or proposed to reduce the turnover tax from 1% from the current 3% to 1%. But as you know, turnover tax applied to people whose turnover was under 5 million. The bill suggests that we should have it from anyone whose turnover is 500,000 shillings up to 50 million shillings a year. So it's widened it quite a lot, which may be a good measure, because turnover tax has not really worked otherwise. And in that, the presumptive tax that these people had to pay, being 15% of their single business permit, has been abolished as well. All these measures are in the bill. They cannot take effect until that bill is passed and the income tax law is actually amended. Now, the President wanted this to be done with immediate effect, so my assumption is that when they do enact it, which I believe is next week, they will be debating it in Parliament, that it will be backdated to be effective 1st April. Although, interestingly enough, when you read the bill, the change that they have proposed for corporate tax talks about the year of income 2020. So that means that any company whose year end falls in 2020 will benefit from the reduced rate of 25%. On the value added tax side, what the President announced was a reduction of the VAT rate from 16 to 14%. This doesn't require, they don't require to put this in the bill, because the current VAT Act allows the Cabinet Secretary for Treasury to actually change the VAT rate by up to 25% up or down through issue of a Gazette notice, which he did effective 1st April. He then has to get approval from the National Assembly within 21 days. And if they reject, then we're in a position where from the date of 1st of April to the date of rejection, we have 14%, then we revert back to 16%. The good thing is that despite there only being 53 MPs in the House on Tuesday, they actually did pass this change. And then the final thing that the President said, which again is not a legislative thing, is that he instructed KRA to accelerate VAT refunds. And bear in mind that VAT refunds are really only available to suppliers who are supplying zero-rated product or zero-rated supplies. But he has told them to accelerate the refund to assist cash flows. To me, seeing is believing, because I heard this even under President Kibaki. I heard it when Mr. Kenyatta was finance minister. I've heard it time and time again, and it still gets blocked. But hopefully KRA is taking this on board and doing it. So that's the background and the rationale for the bill and the measures that the President wanted. As I said, there were significantly more measures introduced, and I'm going to hand over to Alex Mathini, who's a partner at Bowmans, to run you through those aspects.
Thank you, Nikhil. It's interesting, when I was reading the newspaper reports on the Parliament discussions on the reduction in VAT rate, most MPs seemed to actually be against the reduction, and they were saying that this is not going to be beneficial for the economy. It's going to lead to a reduction in tax losses, etc. And I mean, sometimes it begs the questions as to whether these parliamentarians are actually living in this same country that we are. I'm going to talk through the actual income tax measures, proposed amendments, particularly relating to energy and infrastructure in the country. There's quite a number of amendments that have been made in the bill, so we're just going to focus on the ones relating to energy and infrastructure. Now, as Nikhil pointed out earlier, the corporate tax rate has been reduced or is proposed to be reduced from 30 to 25% for Kenyan resident companies. However, just to counter that, there is a proposed increase in the withholding tax rate on dividends paid to non-resident shareholders from 10% to 15%. Now, of course, I mean, this is quite interesting because I think the aim is to, for purposes of the corporate tax rate reduction, that benefits the Kenyan companies as well as the Kenyan shareholders. But then for the non-Kenyan shareholders, they are not really going to benefit from that because the effective tax rate remains at 36.25%, slight reduction from 37%. Now, of course, the increase in withholding tax rate is subject to the DTAs, the double tax treaties in force. Generally, most double tax treaties will have 10% as the applicable tax rate. Having said that, Kenya does not have a widespread treaty network. The next amendment is in relation to the electricity charge. There was an amendment that had been introduced a couple of years back that allowed manufacturers to claim their electricity charge at 100% plus 30% as an expense. Now that has been removed. I suppose, Aleem, from an energy perspective, does that affect the manufacturers really?
Well, there was two parts to this, right? There was the supposed wanting to grow the manufacturing sector by allowing this deduction, but I think as we've discussed, the conditions you had to meet in order for the deduction to apply were quite rigorous, which meant that pretty much most manufacturers couldn't. I guess the interesting question from a power generator's perspective is obviously the power generators themselves use a lot of backfeed energy from the grid for the operation of the plant, and whether they could have benefited from this deduction as well. I guess it's a moot point now because it's been removed, and I'm not sure many power generators actually looked at this deduction as one that favored them. But again, keeping with the various exemptions that have been removed, even if you were buying power from KPLC to jumpstart the plants, etc., and there was retail tariffs that applied, you can no longer now deduct that against your income. So yeah, to the extent that power generators were adopting this and using it, it's no longer available.
And when, as you pointed out, when I've spoken to manufacturers as to whether they're actually benefiting from this, most of them will say that because of the conditions that have been imposed by the ministry, it's very hard to meet, so not many of them actually claim the deduction.
But also, this is not just the power generation point, right? If you look at large-scale mining, if you look at large-scale oil and gas exploration and production, these are big consumers of power, right? And they will qualify as manufacturers as well, I would suspect. So, you know, if you are incurring large-scale exploration costs, production costs, effectively you are using, like, if you look at countries like Zambia, the biggest off-takers in the country are the mining companies. Right? And so this particular deduction that you could have had, which would be very helpful if you're in oil and gas or mining, has been taken away, which again then makes oil and gas and mining more expensive in Kenya.
But just to say that when this was introduced, this incentive, the ERC laid out 3 criteria for you to qualify to get this 130%. And that was that you had to increase your capacity, increase your employment, and increase your consumption. So in some ways, those were counterintuitive when you think that what we're trying to do is save cost.
But again, I think there's a pure manufacturing element of it, and then there's the transition from exploration to production. And I think if you're in mining, if you're in oil and gas, I think had you been given the chance, meeting those 3 conditions would not have been as difficult as it would be for conventional manufacturing. So, and I don't know if it's been appreciated from that point of view.
I mean, but if you look at the justifications from the Revenue Authority in their policy paper, what they've said is there's not been an uptick in this. Now, the reason there's not been an uptick is because of the conditions they impose. So they are saying it'll not really have a detrimental effect. I mean, it's a case of where the policymakers come up with good policy initiatives, but the implementation of them is almost taking away from the...
but it's also about looking at things in the short term and then the medium to long term.
Yes.
Right? Project gestation periods, whether it's oil and gas, mining, power generation, right? These are not prefab projects which show up overnight, right? Even a solar plant, which is probably the simplest from a construction perspective, a 40, 50 megawatt solar plant will take you 12 months to construct. But the development that goes into that could take 2, 3, 4 years, right? So just because it hasn't worked because you put it in place 12 months ago doesn't mean that it's not an investment incentive for the next 5 to 10 years, right? So I think it's one where they should have given a chance, and maybe something that we can revisit in the future.
Okay. And the next amendment relates to capital expenditure deductions. Now, there was this amendment that allowed any capital expenditure incurred in construction of social infrastructure, schools, roads, hospitals, and similar types of projects. Now, this has been removed, and it's quite interesting because I would have expected this to be maintained to jumpstart the economy. We are looking at a situation where most countries are now thinking they need to invest in hospitals, medical infrastructure, etc. But on the other hand, the incentive, the tax incentive that is there has been removed. It's quite interesting, yeah?
Well, the first point is this is contrary to the president's Big Four agenda.
Absolutely.
Right? And you see social infrastructure. I mean, we can't on the one hand say that we have a roads annuity program where we want to build 10,000 kilometers of roads, but then say we're going to take away the capital allowance. And at the same time, most of these power projects are developed in areas that aren't accessible, right? So if we look at big wind farms, I mean, you've got to make sure that the road from the port to your wind farm is upgraded enough. And in some cases, there are no roads. Now, what incentives? So you're taking away the incentives to build a power plant. On top of that, you're taking away the incentives to build the road that gets you to the power plant.
Yes.
On the other hand, you'll have developers who are mandated both by their lenders, by their own policies, and by the government to do CSR activities and to build social infrastructure. Schools, hospitals, pharmacies, etc., in and around the project site. So again, what we're saying to these people is invest, but do it at your cost, right? Which just doesn't tally well with what we're saying from a macro perspective, which is, Big Four agenda. We want to be 100% renewable energy. We want to double, triple capacity in the next 5 or 10 years. So somewhere out there at government level, there is a bit of a mismatch.
Absolutely. Then this one for compensating tax, it's an interesting one. Now, this was introduced a couple of years back. Interestingly, what they did then was they scrapped away the compensating tax provisions, introduced the dividend tax provisions, but then for power generating companies, they said that they will be exempt from compensating tax, which now was no longer applicable. Now, there's been this discussion with the KRA. Does the reference to compensating tax also include references to the distribution tax? And that's been an ongoing discussion. But with this deletion, that sort of slams the door on the argument because with your power generating companies having capital allowances, which we'll come to in a short while, where they were looking at being loss-making first 8-9 years, but then giving some returns to the investors, they can't. They'll be hit by the distribution tax at 30%.
So the initial compensating tax question was mitigated through a legal notice which said that interest on funds from foreign sources did not attract withholding tax. Yes. So what happened was a lot of energy and infrastructure companies were able to fund capital costs using shareholder loans or funds from outside. And obviously compensating tax or this distribution tax came into play. when you effectively declared a dividend out of untaxed profit. So a lot of the issue that came with compensating tax was taken away. But I think now that we talk about the new proposed capital allowance regime, where companies will effectively become profit-making and have to pay tax a lot earlier than they would historically, I think we're going to have to revisit this discussion around distribution tax, as well as how important thin capitalization planning will become for these companies.
And just on that withholding tax exemption that Aleem referred to, as far as I'm aware, that legal notices has not been, is not proposed to be repealed or abolished. So that's still still there.
Well, the issue, touch wood, but I think the issue with that was, with the new income tax bill or proposed bill, all these legal exemptions would have fallen away, I think, within 3 years, and hadn't been replicated in the bill themselves. So I don't think we can breathe a sigh of relief just yet. And I think this is one we're going to have to wait and see. But I think, Alex, as you talk through the next example around capital allowance, and I think with Nikhil's help, we'll see how the distribution tax and thin capitalization are going to become more important from a tax planning perspective.
Absolutely. There's an overhaul. I think this is the largest overhaul I've seen of the capital allowances, second schedule of the Income Tax Act. Just looking at these, the big one, I suppose, relevant for most participants in this webinar is the investment deduction allowance. And what we had was 100% in the cities of Nairobi, Mombasa, Kisumu, 150% outside those cities for capital expenditure in building a power plant, essentially the building, the plant, the machinery in there. Now,
remember, these solar and wind farms are all done outside just because of the land that you require.
Correct.
So most of them, if not all, would have benefited
from the 150%. So now this has been removed. They've put in a standard rate of 50% in the first year and 25% thereafter on a reducing balance basis. Now, which essentially means, and we'll come to the example in a bit, which essentially means that your power plant will become profitable in 3, 4, 5 years rather than
it's case by case, right? But effectively, we've gone from a situation where you were loss-making for 8 years to one where you potentially become profitable in, it all depends on the amount.
Yes.
But assuming you can only use 50% in year one.
So what I've done in the next slide is,
do you want to?
Is this, this is for illustrative purposes only.
And you say you're not a lawyer, and you start off with the legal caveat.
Working with lawyers, I've become half a lawyer. But I've just assumed 10 million shilling investment. Of course, for the 150%, you needed 200 million. But just for the purpose of illustration,
$10 million.
Well, you can make it dollars as well. That's fine. So you would, under the old regime or the current regime, you either get 100% deduction or you get 150% deduction, and that effectively means that in year one, your tax losses have gone up by 10 million or 15 million, depending on which part of the country you're in. Under the proposals, you will get in year one 50%, and then, which I've got their allowance year one, if you look on the right, and then the residual value, which is the 5 million, you will get 25% a year, but on reducing balance. So I've taken the calculation up to year 4, but so effectively this is going to go down 8, 9, 10 years. In fact, reducing balance, it'll never end. It'll just be infinite, but the number will become much smaller. So the impact on your tax losses in year one is going to reduce quite significantly. And therefore, you will probably be having taxable profits earlier than if you got a big hit, in a big allowance in year one under the current regime. So therefore, you may be in a position to do a distribution to your shareholders without incurring the wrath of that distribution tax of 30% because you haven't paid tax on the income. So in some ways, that's a good thing. In others, though, particularly those that are perhaps planning now and have reached a long way down the line, all your cash flows are going to change completely as a result of this. Yeah. So that's something that you're going to need to think about going forward.
Yeah.
So I think in our concluding points, we'll talk a bit more about that from a project and project finance perspective.
Okay.
And sorry, if I could just add, we are getting questions through on the chat and some emails. We'll respond to all those at the end. So just bear with us on that, please.
Okay.
Okay.
And then just quickly talking through the other capital expenditures which have been amended. Again, for petroleum gas storage facilities, the investment deduction allowance was 150%. That's been amended to be 50% for the first year and 25% on a reducing balance basis for the residual amount. Motor vehicles, heavy moving machinery, equipment, that was 37.5% for heavy moving equipment. That's been reduced downwards to 25%. Telecommunication equipment, that was previously 20% on a straight line basis. It's been made 10% on a reducing balance basis. Again, things like furniture, fittings, all that's been reduced. Now, essentially, what we are seeing from this is there's just reductions. Is it really to just collect more revenues?
Well, I think that's definitely one of the reasons. But these proposals that they've made, if you look at the income tax bill 2011, I think, no, 2017,
yeah.
18. They've actually taken this directly from the income tax bill.
Yes.
So this was always on the cards. It's just that the income tax bill didn't progress. So we're moving away from what we had to what was proposed in the income tax bill. I will say that what they're proposing, and when you compare it to the current law, it certainly makes the law easier to follow. And from that perspective, that's a positive, because clearly if there was no clarity, then the tax wasn't working as well as it might. But the other point I will make, which may not necessarily impact on this industry, is that we have under the current law an option when you're doing a transfer of business between related parties. You had the option to elect for a tax written down value transfer. That has been removed. So where you're doing transfers of business now, it's likely to become more expensive to do so. But that's just one of the things that's just fallen out. So let me, Alex, thank you very much. Can I hand over to Denis Magonga, who will just take you through the VAT measures that have been introduced, and then I'll come back and talk about some of the others. So Denis, over to you.
All right, thanks, Nikhil. My name is Denis. I'm an associate at Bowmans. I'm going to take you through the VAT changes in the tax laws amendment bill that specifically affect the energy and infrastructure sector. So the first major change is the reduction of the VAT rate from 16% to 14%, which Nikhil has already touched on. The other change is that the taxable value of goods subject to the special rate of 8%, so mostly petroleum products, petroleum goods. Calculation of the taxable value will now specifically include excise duty, fees, and other charges, which was previously not the case. So we expect to see that the cost of these petroleum products is going to increase for the consumer, because higher fees are going to be charged, and the consumer will end up paying a higher rate for these services.
Just to touch on that one, just to add to what Denis is saying, the VAT law is quite clear in arriving at the taxable value. These items, excise duty, fees, charges, import duties, etc., had to be included in arriving at the taxable value upon which you apply the VAT rate. In the case of the special rate 8%, there was a specific dispensation taking these out. So they've now added it back. So Dennis is right. We're going to see, theoretically, we'll see an increase in fuel at the pumps. What is in our favor, of course, is with COVID-19, the oil prices have also collapsed significantly. So petrol, I believe, has gone to the lowest level in 13 years or something like that.
So with the oversupply in the market, in the global market.
So make sure you fill up your cars before the next revision comes through is the free bit of advice I'm going to give you. Sorry, Dennis, back to you.
Just to add to that, from a consumer perspective, the problem with this and some of the other measures we've got is, so if you're effectively buying fuel as a power plant, the cost of that fuel to you just increased, right, from a VAT perspective. Now, what happens is on most of these diesel plants, the fuel charges are a complete pass-through to the consumer. So from a power plant perspective, from a generator's perspective, there's a mild, I'd say, cash flow issue because you're paying a bit more in terms of VAT, but that entire cost, this increase in taxable value, will now just be passed on directly to the consumer. So you may be saving income tax, you may be saving on PAYE, but your electricity just got more expensive.
Yeah.
Right? And it's measures like this that people complain that we have all this renewable energy, why isn't the cost of power getting cheaper? This will be one of the reasons why.
Yeah, okay. The other big change is around reclassification of certain exempt and zero-rated supplies to standard-rated. And just before we look at the supplies which have been reclassified, just to touch on the difference between exempt supplies and zero-rated supplies. So exempt supplies are not vatable. Zero-rated supplies are vatable, but at the rate of 0%. And you can claim input VAT credits in relation to the VAT incurred in acquiring services or goods to make the zero-rated supplies. So the difference is for zero-rated supplies, you can claim input tax. For exempt supplies, you cannot.
So just expand on that, right? If that's the explanation. So if we take ordinary bread as an example and they made it exempt, does that help the consumer?
For exempt services, no, because what the supplier is going to do is they'll pass on the costs of VAT, which they cannot recover to the
Straight
consumer.
to the consumer.
Yes.
Straight to the consumer.
Yeah.
And it's interesting, over all these years that I've been doing tax and I've been speaking to parliamentarians, they focus on the word exempt.
Yes.
And to them, exempt means no tax. But there seems to be a lack of understanding of what exempt actually means from a VAT perspective, which, as Dennis says, is that you cannot recover the input tax that you are charged. And therefore, your prices are going to go up. On the other side, zero rating, you can recover, and because you're zero rated, you can apply for a VAT refund, which was one of the things that the government was trying to get away from, because there were too many zero rated items, and VAT refunds were increasing quite significantly. So again, there's a balancing act, which there probably isn't a yes or no answer to, but it's one the government has to deal with. Sorry, Dennis, just.
Yeah, and the supplies which have now been reclassified to standard rated, once again, we go back to the discussion Nikhil and Alex were having around balancing revenue requirements against incentives given to taxpayers operating in the energy and infrastructure sector. A couple of the supplies which have now been reclassified to standard rated specifically pertain to areas where the government had previously indicated intention to incentivize the persons operating in those sectors to try and grow them in recent years. And now the exemptions, the zero rating that had been given to those persons is proposed to be reversed, and VAT is going to be charged at the rate of 16%. So, for example,
14%.
Sorry, to 14%, yes. So, for example, the wind and solar sector, inputs for manufacture of solar equipment for use to store solar power are now going to be standard rated. Specialized equipment for development and generation of solar and wind energy is now going to be standard rated. The same thing for supplies for construction of power generating plants, supplies for equipment for development and generation of solar and wind energy. The same thing for goods and services, for projects under a special operating framework entered into with the government, which Nikhil is going to touch on. And it's the same thing across the various sectors.
So Dennis, from a practical perspective, what we're saying here
Yeah.
is effectively the first exemption is any power project, as long as you're supplying to the national grid.
Yeah.
This doesn't distinguish between wind, solar, hydro, or
Yes.
geothermal.
Yeah.
So any project that's supplying power to the national grid, and one would argue that's probably the only exemption we ever needed. The rest of these around wind, solar, etc., and getting granular, or maybe just over and above that.
Yeah.
But your capex just went up
Yes.
14%,
Yeah.
correct?
Yeah. Yes. That's for sure. Yeah.
And there is, of course, the question of if we assume, as I said at the outset, that these measures will come in on the 1st of July, will they have retrospective effect on a current project that is already underway?
Yeah.
My own view is that they won't, but what the bill doesn't do is specifically say that. So that again is an area of concern. But I mean, there's a host of case law that we can rely on about retrospective taxation, which is all in favor of the taxpayer by and large.
But Nikhil, these goods come in consignments, right? So if I've got
Yes.
goods in the high seas,
Yes.
right, and it lands in Kenya on July the 2nd,
Yes.
and this comes into effect on July 1st, then what?
Well,
Because
now,
that's not retrospective.
so except that if you had signed up an agreement to do this with the government pre these changes, I think there's and I'm going to put my lawyer hat on now, there is a legitimate expectation that you will continue to get the same exemptions because you've already signed up that agreement.
Yeah.
And so I would assume, and again, not to be quoted, I would assume that when the final act comes out from this bill, that we will see some sort of provisos as to the effective date and what happens with existing projects. And I'll deal a bit more with that when we talk about special operating frameworks as well.
Another thing, Nikhil, I've had been bandied around to persons that's is for power producers, yes, they'll pay the VAT, but it's only a timing difference because once they start production, they are going to recover. Now, of course, you import, as Aleem was saying earlier, constructing a power plant takes time, right? Before you start, your COD is 3, 4, 5 years away. So waiting for that 4 or 5 year period to recover these expenses is really, it's just a big hit, right?
Yes. So you're right. You won't lose it. You'll get it when you start generating the power, as it were, because then you're starting to charge VAT. So you're taking this input credit, but it's going to be such a substantial number that it's likely to take you another 3-4 years to exhaust it. So you probably are not going to be in a VAT output position for a number of years down the line. The impact, though, is because you're having to pay 14% on those imports at this point, or indeed for the local purchases, your cash flow is going to go completely askew.
Yeah.
And I think that is the key thing. The cash, you get this back, so it is a timing difference, but your cash flow in the early years, whilst you're in that development stage, construction stage, etc., are going to be very significantly impacted. And that's where the problem comes. Okay.
That's it.
Yeah. So, Dennis, thank you. Let me move on to other measures and taxes. Just click ahead. So the miscellaneous fees and levies Act has been amended, was proposed to be amended. Import declaration fee is increased from 1.5% to 3.5% on inputs and raw materials. Now, bear in mind the 1.5% came in with Finance Act 2019 last year. Now, I'm not 100% convinced that this is what the legislator intended, because the way they've just said delete. but they haven't talked about does it go somewhere else. So there may be some confusion as they debate the bill. Maybe some clarification will come out of that. If you are importing motor vehicles, so that's any type of motor vehicle, excluding a motorcycle, or indeed purchasing it locally, there is now a 10,000 shilling processing fee. So it's going to obviously increase your costs, may not be a significant number, but it's going to increase your costs. It's certainly going to increase your costs if you as an individual are planning to buy a motor vehicle, because you're going to have to pay this 10,000 shilling processing fee. IDF on goods that are imported for construction of liquefied gas storage facilities, it appears from the way they've deleted this that that's now going to be subject to 3.5% rather than 1.5% or exempt, I think it was at that point. So here's another increase. And then finally on the railway development levy, the law used to provide that if there was, the cabinet secretary would determine whether you can get an exemption based on public interest. However, you had to be doing it for a project that was in excess of 200 million shillings. That 200 million shilling cap has been removed. But like all our tax law, there is nowhere a definition of what public interest is. And it always worries me that the cabinet secretary seems to have the sole power to decide whether it is in the public interest or not. But anyway, that's the way it is. Moving to the right, special operating framework arrangements. This was introduced in 2018, whereby for income tax, VAT, excise duty, and miscellaneous fees and levies, the government was allowed to set rates despite what the law said, if it felt that the project was, if it was an arrangement between the investor and the government directly. So the people that have sort of benefited from this are vehicle assemblers, for example, the assembly of the VWs and the Peugeots. They're benefiting from a 15% corporation tax rate, where everyone else currently pays 30%. So they've now removed this completely in all those laws, or proposed to remove it. Given that we need there are a series of projects that are underway, the oil pipeline, for example, those were the sort of projects that should have benefited from this legislation, and have in the past, in the last 2 years. But its removal means that any of these big infrastructure projects will no longer benefit from getting special rates. And we can discuss that in a little bit more detail in a minute. And unfortunately, they've gone, so they've only been around since 2019, I beg your pardon, not 2018.
It lasted a year.
And they've lasted a year, like a lot of things. So Aleem, let me hand over to you to talk about the industry as a whole.
Thanks, Dennis. Cheers. Yeah. So, I guess what does all of this mean? What we're covering today, I guess, if we look at where we're coming from, Kenya in the mid-90s, acute power shortages, load shedding, no unbundling of the power sector, no tax exemptions, and very little investment in the sector. What subsequently happened, we've unbundled the sector, we've had in place very good policy and regulatory functions and framework. We've moved towards market-oriented power purchase agreements and generally adopted policies that have driven foreign direct investment in the energy and infrastructure sector. The success of that, I think, is evident for everybody. We have probably one of the highest percentages of clean energy in the world. I think we've ranked 7th for geothermal capacity worldwide just recently. 50% of the installed capacity since the 90s, if not more, has been driven by IPPs, by independent power producers. Even though most consumers want to blame IPPs for high power prices, I assure you that's not the case. And we've mobilized upwards of $3 to $4 billion of investment. That's obviously meant investment in the country, forex in the country, employment, jobs, etc. So, there is a very successful story to be told. So why are we going now in the opposite direction. To us, the tax laws amendment bill is part of a systemic and continued targeting of the energy and infrastructure space. What do we mean by that? Over the last 2 years, we've seen a substantial reduction in feed-in tariffs, but an increased risk appetite or risk allocation being passed on to the private sector. So the government is saying, instead of 12 cents for solar power, we're going to pay you 7. Some of that reduction is warranted because of, technology advancements and the price of panels being reduced. But at the same time, they're saying we're going to only, we want you to deliver power for 7 cents, but at the same time, we're going to take away your tax exemptions. We're going to make land more expensive. We're not going to cover you for piracy or terrorism. And we're going to make it hella difficult for you to claim under your letter of support. We've talked about project gestation periods. These projects take 4 to 5 years to develop, and before you even start construction in most cases. I mean, Lake Turkana took the best part of a decade to develop before they even started construction. And these are important projects for the country. You need to have a stable legislative framework. You need to have certainty around your investment climate. If you're going to change that every year or every 2 to 3 years, then people will have a look at Kenya and they'll have a look at the countries around Kenya, and they'll pick a better place to invest. And I think that's a reality that the government needs to come to terms with. We're not the only show in town, and there are other options out there. And I think if we look at a lot of the investment we've lost to Ethiopia already, then I think this is not just speculation. This is a real issue for the government to consider. You've had KRA taking enforcement action against IPPs on everything from, I think, the split of goods and services on offshore components, on legitimate tax exemptions, which they've relied on.
Tax on services,
on offshore services. And so you've got to ask yourself, why is this happening? And obviously this tax laws amendment bill is now the sort of the icing on the cake for most IPPs and most people looking to develop projects in the energy and infrastructure space. So, for people out there who are developing projects, what does all of this mean for you? If you look at projects which are in development with no power purchase agreement signed or no project agreement signed, then you're in a pretty tough space because you spent money, and effectively all that money is now a sunk cost if you choose not to proceed with the development of the project. And in most cases, with a fixed tariff and increased capex, you may actually choose not to invest. So you don't have any specific contractual recourse. You may, depending on the country you're investing from, look at possible remedies in a bilateral investment treaty with Kenya. But again, to take that road and to take the government, make an investment claim against the government may not be sort of worth your while, depending on where you are in the development phase. Something a bit more positive, let's say you do have a signed project agreement. The general principle adopted along most of these agreements is that the taxes applicable as at the signature date are paid by the seller, in this case the seller of the power, in accordance with the legal requirements, and the tariff is deemed to be inclusive of all such taxes. You will have stabilization provisions, you will have change in tax provisions that protect you in the event something like this bill is enacted. But what you need to check is that you have that specific protection, and you also need to check when that provision is effective. Some power purchase agreements we've seen will say that the change in tax provision is only effective from financial close and not from when you signed the PPA. So I think that's one of the key things that people out there with a PPA need to check. If you're a project in construction or operation, the general rule in Kenya is if you're a project above 10 megawatts, you will normally get a letter of support from the government to complement your PPA. So under the PPA, you'll have to, assuming you have change in tax relief, the general measure to adopt is to make a tariff adjustment application to the Energy Regulatory Authority. And what you're looking for is effectively a tariff adjustment which puts you in the same position you would have been had the change in tax not taken place. This will be something you either agree with KPLC or get a third-party expert to determine. You then make an application to the regulator who has to approve all tariffs. The difficulty with that is obviously that the regulator has been under pressure to reduce tariffs, and so to get to a position where they'll actually accept a tariff increase is probably quite unlikely. So in that case, your recourse is to your government letter of support. The government letter of support effectively allows the government to insulate projects from a change in law or change in tax, whether a remedy under the power purchase agreement, which is an increased tariff, hasn't been possible because the regulator basically just said, no, I'm not increasing the cost of power to the consumer. The one issue with the letter of support that you need to be careful about is the letters of support provide for the formation of a risk management committee. Without a risk management committee, you can't have certain risk management committee meetings, which are a precondition to you issuing what's called a political event notice under a letter of support. And it's an administrative step that you need to make sure you put in place, because if you can't have a meeting, you can't issue the notice, which means you don't have relief. So for everyone out there that has a letter of support, you've got to make sure as a first step that your risk management committee has been put in place for your particular project.
And does that include external parties, the government?
It does. The risk management committee is comprised of people from Treasury, the AG's office, Ministry of Energy, the IPP. So it's a select group of people.
So if you've not constituted it, it might be a challenge to actually...
It might be a challenge to actually make a claim against the government. Okay. Because one of the trigger points is that meeting having happened, okay, and no recourse or relief being offered to you within 30 days of that meeting, for example. Okay. So I think we would ask everyone to quickly have a look at their letters of support and make sure that those committees are in place.
And is there a likelihood of the government just dragging its feet?
It's possible, right? It's possible, absolutely, especially at a time like this. Yeah. They're not incentivized to really help you out. Yeah. That being said, there is normally some general language in the letters of support that require the government to take reasonable steps to prevent, limit, or minimize the impact of the political event. Okay. The problem with that is from a change in law and change in tax perspective, what can the government do other than not pass the law, right? And maybe it'll come down to some of the provisos that Nikhil spoke about. So, yeah, look, the stabilization provisions are also available under most petroleum agreements, but they don't go into as much detail as project agreements for PPPs and power projects do. So I think there's a wholly different engagement with the government on a petroleum agreement, which is more like an agreement to agree.
It's an agreement to agree, and if you do not agree, then you take it to arbitration.
Correct.
And hopefully the arbitration comes up with the proper remedies.
Now, we've talked about some of these changes being ill thought, and I think the extractives industry, oil, gas, and mining are good examples of this, because under most of those agreements, government will have a step-in right, effectively on production commencement. Your government has the right to sort of step in and be a participant in the project, but in order to do that, the government has to cut a check, which is the commensurate amount of cost that the government would have borne had they participated from the beginning. So what the government has essentially done, if these changes are passed, is made it more difficult for the government, or more expensive for the government to participate, because the amount of that check just went up by a significant amount. So again, we're talking about short-term plans which are in place to compensate for lost revenue from the COVID-19 measures. But again, if you look at this over 5 to 10 to 15 years, then you do have to question the logic behind some of these changes. So I think that's where I'll stop around, some of the remedies and reliefs that are available, and I'll pass over to Nikhil to go through some concluding comments, and then we'll deal with certain questions we've got from the participants.
Okay, so what should you be considering, given this bill in its current format, and the impact that it's going to have on your industry? Well, I think one important thing is that you're going to have to look at its impact on the debt covenants that you have, and perhaps you need to have them renegotiated or
yeah, you will do, because most facility agreements will have various debt covenants around debt service coverage ratios, and general cash flow availability of the project. What these changes will do is obviously significantly change the cash flow profile of the project SPV. So whereas the day before these changes, you might be in a position to pass the various covenant tests. Effectively now, because of the adjustments you've got to make as a result of maybe a new capital allowance, or as a result of increased capex, as a result of increased corporate tax that you're paying, you may have to relook at a lot of those covenants and plug in these changes into your financial model to see if you still meet a lot of those lender covenants.
And in the same vein, can you look at your debt and have it rescheduled to ease your cash flows? Shareholder debt, maybe you could consider capitalizing it to avoid thin capitalizations issues. And that's subject, of course, what Alex talked about, the distribution tax or the replacement for compensating tax.
So just to add to that, and I think this is going to be a key point for a lot of our clients, is historically I wouldn't say we've taken the easy way out. We've kind of supported our clients in the view that having equity funded predominantly by shareholder loans is okay as a result of the withholding tax exemption. I think if the new capital allowances are brought in place, if the distribution tax comes into play, then I think we've got to relook at those structures and ask ourselves whether now a blend of debt, shareholder debt, and conversion of some of that to equity actually makes for a better return profile for our clients.
And things like use of preference shares and
because most clients would effectively just ignore the thin cap consequence of being shareholder loan funded. But I think with the new capital allowance coming into play, then I think we need to revisit that thin cap conversation.
Because all your expenses, you've lost a huge investment deduction. So you need to have your interest being deductible.
I mean, you used to be loss making for 8 years, right? So you didn't really care if you lost out on a little bit of thin capitalization deductible interest, but
now it really matters.
It really matters, yeah, absolutely. Sorry, Nikhil, go ahead.
Yes, you may want to review your dividend policy in view of the changes that are proposed. You may want to look at utilizing tax credits that you've got and whether you can actually utilize them in some way. You may or may not be in a VAT refund position, but if you are, let's bear in mind what the president said and push to get them back. Given that you're perhaps in lockdown and may not be able to file your returns, the law does provide, the existing law provides for an extension of time for filing returns, so you may want to consider that. You may, if you're in a tax payment position, want to agree some sort of tax payment plan with the KRA. They're not entirely open to this, just as they're still enforcing, despite what the president said when he announced his COVID-19 measures. And of course, above all, please stay safe. And then finally, my own view is that this bill is perhaps a step in the wrong direction. COVID-19, I think, is going to have a very, very, if it not already has had, is going to have a very significant impact on global economies. And indeed, if you look at the IMF recently issued, it was last week, issued an outlook where they talked about almost negative growth in some countries, the UK going down to 1.9%, the US down to 1.5%. I read on social media, so I don't know how true that is, that Kenya might be at 1% this year. So those are going to have impacts. And then you introduce measures which actually you need post-pandemic to allow us to kickstart the economy. Those tax cut rates that the president announced are actually going to be of more use post-pandemic than now, because people, are not paying PAYE because a lot of people are being laid off. So I think the government has lost its direction slightly here, because they need to now concentrate on immediate relief and what happens if we have to go into a full lockdown, which, given yesterday's statistics where 9 people were thought to have caught the infection through community spread, that might be the only way out of this. So that's something they need to consider. I think post-pandemic, we as a country need to really look at our supply chain. We have been, and not just us, I mean, many parts of Africa, indeed many parts of the world, have been over-reliant on China. And when China shut down January, February, we really had a tough time. In fact, imports into Kenya were 500. They dropped by $580 million, I think, in the first 2 months of the year. We should be encouraging local production, and I think the bill is not doing that because it's taking away a lot of the exemptions that would encourage it. And that's something that they should look at. I do accept that the government financial status right now is pretty precarious. The extended borrowing spree we've been on is now coming home to roost. So it's going to be difficult for them to give the cash bailouts, checks that have been given in the US, albeit with Donald Trump's name all over them, but nonetheless. You can see that sort of thing cannot happen in our part of the world, but there does need to be rethinking around that. That really was all we wanted to say on energy infrastructure and the bill. We've had some questions come in on the chat, which Aleem will just read.
Sure.
We have had one that came in on the email. If I can find it. Sorry, just bear with me. Aleem, if you've got some there, just start.
Yeah, so question to Nikhil and Alex. I think you kind of answered this. What are your views on the proposed withdrawal of tax incentives across sectors? Do you agree with GOK report that the economic impact of the incentives is way lower than what they were intended to achieve? In your view, is GOK strategically making the right decision for the greater good of the economy?
Right, that was the one I was looking for. I think I've answered it as we went along. My one concern with this interpretation that the GOK is putting on it, and indeed that document that KRA issued earlier this week, is that we're looking at the impact on corporate tax principally, because and VAT. What we're not looking at is, do these projects create employment and therefore increase PAYE, foreign exchange earnings to the extent that they're there. So from that point of view, I do think that the GOK, while right, I'm not a great believer in blanket exemptions. I think we need targeted exemptions, but what they've done here is taken out all the targeted exemptions as well. And I think in the long run, that's going to be detrimental to the Kenyan economy. I think there was a second question, unless that...
Yeah, I mean, I'd say that. I mean, take one sector we've not focused on is only obviously on the solar manufacturers. There's these solar manufacturers. There's been it's been great because they enable the people out there who are not served by the main electricity grid to get power. But then with some of these amendments, where a lot of the exemptions have been taken away, it makes solar pay-go power very expensive. Now, it has it doesn't work because what that means is I who was going to buy that for 3,000 shillings, that becomes 3,500, 3,600 shillings, and with my competing needs, I will not buy it. So the government will not collect the tax it intended. So I think it has the it will not achieve the intended purpose, in my opinion.
An interesting question on the chat around withholding VAT. The question is KPLC now withholding part of the VAT on sale of electricity? In general, I'm quite follow the changes to withholding VAT and withholding agents, but is that something that's happening?
There's no change to the law on withholding VAT.
Not now. It used to be previously 6%.
Yes.
That was reduced to
2% of taxable value.
Yes.
Yeah.
I think KPLC is an appointed agent for withholding VAT. So yes, generally, I would think they do.
Yeah. So and that's at 2%.
At 2%.
At 2%, yeah. That's not.
So they do withhold and they do it at 2%.
At 2%.
I mean, as an aside, I actually think withholding VAT is the most nonsensical tax I've ever seen. Because if the intention was to widen the tax base, you're not doing it because you're withholding from people who are charging. So therefore, they're already in the net. To me, we would be much more sensible as a country to do what I think Uganda does, which is unless you are given a specific exemption from the URA, your customers are required to withhold 6% on goods and services, unless you can produce an exemption certificate. That way, you're going to bring people into the net. Doing it on VAT is just complete nonsense to me. But anyway, that's what it is.
So I think, yeah, for me, I mean, the final word, I think there are a couple of other questions which have been asked privately, so maybe we'll just respond to those directly. I think in conclusion for me, I think for the consumer, for the developer, for the country as a whole, the withdrawal of incentives on extractives, energy, social infrastructure are not what we need, and we're hoping and we're lobbying for the government to relook at the withdrawal of these exemptions, because in the medium to long term, they're going to set us back to where we were, or pretty close to where we were in the mid-90s, which I don't think is a place anyone wants to get to.
So just final comments. Thank you very much, everyone, for joining the webinar. I must say, for me, this has been quite different, because I'm used to having someone sitting in front of me and interacting with them and cracking jokes, but I find it quite difficult to do on a webinar. But anyway, there we are. We did send out earlier this week or late last week a write-up and with our thoughts on the implications of the bill. It's due to be debated next week, and what we will do thereafter, once it is enacted, is to send an update between bill and act for you to understand what the real measures were. So thank you for joining us. Stay safe. Wear your masks and whatever else that you've got to do. And look forward to seeing you at the next one that we do. Thank you very much indeed.
Thank you, everyone.
Thank you.
End meeting.